I want you to open your bank app right now, not to check your balance. Scroll through every transaction from the last 30 days and flag every charge you didn't consciously decide to make on that specific day. The $12.99 you forgot to cancel. The processing fee on something you bought in February. The annual plan that renewed without a single notification. Every one of those charges has something in common. It's called phantom debt. And once you see it, you will see it everywhere. But before you blame your habits, these leaks are not accidents. Someone built this. And this video is going to show you exactly who. Let's start with where the average person is in 2026. Most people think about debt as the big stuff: mortgages, student loans, credit cards. The average American household carries about $104,000 in total debt. You've probably seen that number. But there's a different number nobody talks about. $2,400 per year. That's what the average household loses to charges they didn't consciously choose to make. Not fraud, not theft. Completely legal, completely invisible. Subscriptions that renewed while you were sleeping. BNPL installments coming out on dates you don't track. Fees that appeared after the price you agreed to. Loan balances from a car you don't even own anymore. This is phantom debt. And here's what makes it different from regular debt. Regular debt you know about. You applied for it. You signed something. Even if you regret it, you can see it. You know the number. Phantom debt lives in the gaps, in the auto renewals, in the fine print, in products specifically designed not to feel like debt at all. The number is invisible until someone shows you how to count it. It has levels, and the level you're on is doing very specific things to your financial life, most of which you cannot see without someone pointing them out. So that's what we're doing today. Level 1 is where almost everyone starts. It's dangerous not because it's large, but because it feels like nothing. This is the Klarna stage, the afterpay stage. You're buying trainers for £90. Klarna splits it into 4 payments of £22.50. You click it because £22.50 feels manageable, and £90 doesn't. That's fine, for one purchase. But the average BNPL user has 3.2 active installment plans running simultaneously. Money is leaving your account on dates you didn't choose, in amounts that shift week to week for purchases you made in different months. It's not one thing. It's a rotating cast of small things that never fully settle. And underneath that, subscriptions. The average person thinks they're paying for 3 or 4. Research shows the real number is closer to 12. The gap between what people think they're paying and what they're actually paying runs $80 to $150 a month before a single intentional purchase. What does $1,800 a year actually mean? If you invested that amount starting at 25, by 65, you're looking at around $350,000. That's the retirement contribution phantom debt at level 1 is quietly replacing with nothing. The cruelest part? It doesn't feel like a financial problem. It feels like a personality problem. People at level 1 call themselves bad with money. They think the issue is discipline. It's not discipline, it's architecture. Here's something to hold on to as we go through the levels. Klarna is not sold to retailers as a payment tool. It's sold as a conversion rate tool. The pitch, in their own documentation, is that smaller numbers get customers past the hesitation moment at checkout. The moment your brain registers the full price and thinks, "Can I afford this?" The split payment exists to get you past that moment, not to help you manage money, to help the retailer close the sale. We'll come back to who built this and why. Keep that in the back of your mind. Level 2 is where phantom debt gets teeth, and it almost always starts with a car. You finance $28,000 over 72 months, 6 years, which is now the average car loan term in America, because the monthly payment looks manageable when you stretch it long enough. You drive off the lot. First thing they don't tell you, a new car loses roughly 20% of its value in year 1. Your $28,000 car is worth $22,000 before you've made 12 payments. But you still owe close to $25,000 because early payments on a long loan are almost entirely interest. 18 months in, you want to trade up. The dealership runs the numbers. Car is worth $17,000. You owe $24,000. That $7,000 gap is negative equity. You owe more than the asset is worth. The salesperson doesn't say you're stuck. They say, no problem, we'll roll it into your new loan. Rolled in, like it evaporates. It didn't evaporate. You are now making monthly payments on a car sitting in someone else's driveway. 32% of U.S. car trade-ins in 2025 carried negative equity. Average gap, $6,000. Average times this happens to the same person before they catch on. Twice. Which means some people carry $12,000 to $15,000 in ghost debt from vehicles they no longer own, folded into the loan of the car they currently drive, invisible, paying interest on it every month. And while that's happening, remember those BNPL balances from Level 1? Most BNPL companies don't report to credit bureaus while you're paying on time. Your score looks fine, but the moment you miss a payment, the debt gets sold to collections, and a collections entry doesn't appear gradually. It appears immediately, with the full balance, and tanks your score overnight. At Level 2, your credit score looks okay. Your bank balance is positive, but there's a shadow balance sheet nobody printed out for you, and the financial system has no obligation to show it to you. That feeling of being fine, but somehow always behind. This is the structural reason for it. You are not mismanaging money. You are carrying obligations the system deliberately made difficult to see. Before Level 3, I need to stop the video. Everything so far, the subscriptions, the BNPL traps, the rollover, sounds like a list of mistakes people make. I'd be lying if I let you leave with that framing. This is not a series of mistakes. It's a system, and it has a paper trail. 1994. The first deferred interest credit products launch. Buy now, worry later. The fine print. Carry any balance past the promotional window, and you owe the full retroactive interest from day one. Designed to feel forgiving, not forgiving. 2008. Financial crisis, credit tightens. A huge chunk of the population, younger people, lower earners, anyone already fragile, loses access to traditional credit. Banks need a new product, something that looks accessible, something that doesn't look like credit, so it doesn't have to be regulated like credit. 2013. Klarna scales into the U.S. Afterpay follows. The retailer pitch. Your conversion rate goes up because small numbers feel safer than big numbers. The consumer pitch. It's not debt, it's just splitting. 2019. BNPL industry. $8 billion. 2023. $309 billion. That's not organic growth. That's an engineered product filling the gap left when traditional credit got gatekept. Built specifically in the regulatory gray zone, without the consumer protections credit cards are legally required to carry. They didn't call it high-interest credit. They called it flexible payments. They called it financial wellness. Klarna ran ads with the tagline, smooth, 3 O's, like a spa day. They stripped the word debt out of a debt product and sold it as empowerment. And they aimed it directly at the demographic being locked out of homeownership, squeezed by wage stagnation, and told their financial stress was a mindset problem. They targeted the disappearing middle class with something that looked like breathing room and was a trap with a very long fuse. Level 3 is where phantom debt stops being a financial inconvenience and starts reshaping your actual life. Housing options, job prospects, your ability to start over. Because at Level 3, the debt isn't just invisible, it's multiplying without your participation. Here's one way that happens. A creditor settles with you, accepts $4,000 on a $12,000 balance. You breathe for the first time in months. You think it's over. It's not over. The IRS calls forgiven debt phantom income. If a bank forgives $8,000 you owed them, the government treats that as income you received and taxes you on it. You get a 1099-C in January, a tax bill on money that was never in your account. In 2023, over 73,000 Americans received unexpected tax bills on income they never actually had. Average bill, $2,100. For people already in financial difficulty. People who thought the worst was behind them. People who did the right thing by settling. Taxed for it anyway. And then there's your credit report. If you were ever added as an authorized user on someone else's account, a parent, a partner, their entire payment history is on your report. Every missed payment, every time they got into trouble. You didn't make those decisions. Doesn't matter. This is a shadow trade line, and 1 in 5 credit reports has at least one error like this. The dispute process routes your complaint back to the creditor who made the error, who is also the Bureau's paying client. The CFPB found systematic issues, fined all 3 bureaus. They paid. The fines were cheaper than fixing it. Nothing changed. But here's the layer almost nobody talks about. And this is the one that genuinely kept me up. Equifax, TransUnion, Experian. The ones you can check. The ones with a legal dispute process. There's a second layer with none of that. Companies like LexisNexis, Risk Solutions, and SageStream operate shadow credit bureaus. They collect rental history, payday loan applications, utility arrears, insurance claims, and sell it to banks, landlords, and insurers as a secondary screening tool. This data doesn't appear on your standard credit report. You can't see it at annualcreditreport.com. Most people don't know it exists, but a landlord can pull it, a bank can pull it, an insurer can use it to set your premium. It's called a shadow score. No standardized dispute process. No public awareness. Decisions about your housing, your banking access, your cost of living, being made from data you've never seen. At level 3, you don't just have a debt problem, you have a visibility problem. Your financial identity is being written by institutions that profit from keeping you in the dark. I didn't make this video to scare you. Phantom debt works because you don't know it exists. Once you can see it and name it, it loses most of its power. 4 things. Actionable. In the next 48 hours. 1. The phantom audit. Open your bank app. Go back 90 days. Flag every charge you didn't consciously make on that specific day. Add it up. Write the number down. Most people are genuinely shocked. That number is your starting point. 2. Pull your real credit report, not Credit Karma. Go to annualcreditreport.com, the federally mandated free report, 1 per bureau per year. Download all 3. Look for accounts you don't recognize, accounts marked open that you know you closed, trade lines from accounts someone else added you to. 1 in 5 reports has an error affecting your score right now. 3. Find out if your car loan is underwater. Go to KBB or Auto Trader. Get the current market value of your car. Call your lender and ask for the payoff amount, not your balance, the payoff amount. If payoff is higher than market value, you are carrying negative equity. Know that number before you ever walk into a dealership again. 4. Request your LexisNexis consumer file. Go to consumer.risk.lexisnexis.com. It's free. It's your legal right under the Fair Credit Reporting Act. What comes back is the data being used to make decisions about your housing, banking, and insurance. Data you've never seen and were never told existed. Phantom debt is designed so that when you feel financially stressed, you blame yourself, your habits, your discipline, your choices. Both things can be true. Your choices matter, and the system is designed against you. The difference between someone who escapes phantom debt and someone who doesn't is almost never discipline. It's almost always information. Someone told them what to look for. You can only do something about the part you can see. Now you can see it. Share this with someone who needs it. And I'll see you in the next one. Take care.